when you buy a property and the title is transferring, right? The ownership of the property is transferring. Remember how I distinguish seller financing from a lease option. Lease option gives you control of the property, it does not give you ownership. Sub to seller financing, owner financing, whatever you want to call it, gives you ownership of the property. You now, the deed is in your name, the title is in your name. And because of that, transfer taxes are paid on the sale of real estate. On a lease option, you don't have that until somebody actually exercises their option and then the deed transfers. So you have to be mindful of your state's transaction fees. I was talking about Ashley's deal last night, so let's use Texas. Extremely cheap. Ashley was shocked at how cheap it was to close that sale. The transfer taxes in Maryland are practically obscene. So when you are saying to sellers, hey, look, we'll just take over the payments on this, we'll take care of your closing costs, we'll take care of our closing costs, you can just move on, we'll get this loan paid off at some point in the future. While that is true, understand that on a $500,000 house, you might be in for 30 grand when you're covering both sets of closing costs just to close on the thing. That's not even including equity, any equity in the house or down payments or anything. That just goes straight to the county. Again, I don't know if that's the exact number, but there are states that have really high transfer taxes. So you should be mindful of that before you decide what structure to use. Now, my opinion, and I won't say that joke, but opinions are like gluteus maximuses. Everybody has one and most of them stink, right? But my opinion on that is that eliminates quite a lot of the competition when the closing costs are that high. And we can go and snatch deals up there. And I also know that when I buy a property subject to the existing debt, I am going to get a fairly large payday from my buyer in the form of a non-refundable fee that is going to offset what I just put out to buy that property. So, paying even up to 6% if I'm handling both sides of a closing, I'm going to get more than that in a non-refundable option fee. I will compromise most of my front-end payday, but now I have the house. Now I own the house. Now I have the cash flow. Now I have the equity buildup. Now I have the potential for appreciation, and I've put myself in a good spot. Now, it is understandable, though. Another state that's like that, I believe, is Washington. It's not like really cheap like it is here in Nevada, like it is in Arizona, like it is in Texas. When you are concerned about that, instead of buying the property with owner financing, taking it sub to, creating a wrap, that kind of thing, you could just opt to lease it with an option to buy and avoid all of those transfer taxes altogether. There could be an argument for sandwich leases being a way better way of going in some states. So just be mindful of what the potential downsides are sometimes on seller financing structures. Here's another one. If you're gonna sell with owner financing, unlike what you do on a lease with an option, meaning you don't really sell it until it becomes a traditional sale when someone's ready to exercise their option to buy. If you give somebody the deed to the property in exchange for a note and mortgage, which is what seller financing is, that means if they stop paying you according to the terms of the agreement, you're going to have to bring a foreclosure lawsuit to get the property back. Time consuming, costly. This is why I say lease with an option is my favorite exit strategy. But if somebody squeezes enough juice into my bank account in the form of a down payment, I'll seller finance it to them. But it ain't going to be 10, 20%. It's got to be much more than that, because I don't want to put myself in any kind of position to foreclose, particularly if we did have a market swing. In 2008, we saw market swings that exceeded 50%. $1 million house is now worth $400,000 in some markets. Those markets have come all the way back. They've come roaring back. So as long as you had positive cash flow, things worked out for those of us who didn't take risks with our credit and with our own money. But you see a swing like that, it doesn't feel so good, particularly if that you put your seller now in jeopardy too if you stop paying on it, which you shouldn't do. So I don't want to give up the deed to the property unless I have a considerable amount down, which we already covered. Those are the downsides, but Hey folks, it's Joel. I know what it's like to maybe, not know exactly where to start with real estate investment, because that was me 30 years ago, at least $30 million ago as well. So look, do yourself a favor. Stop being so freaking shy. Here's my cell phone. Text me right now, 702-364-2323. I bet it won't take me very long to respond to you, and it will be me personally. I'll help you with whatever you need. I've got your back. Now let's get back to the video. Take a look at how the terms deals in general, meaning deals that involve payment structures over time, that's terms. Let's look at how we get paid, because there are so many paydays. And this is a slide you should really internalize, so that if you're talking to people about, over the Memorial Day holiday and somebody's like wholesaling this or wholesaling that or real estate, they don't think you're gonna, be able to make money or something like that. Be in a position where you can articulate just how profitable this business model is, because it's extremely profitable. So when I have a property and I didn't use my own money and I didn't use my own credit, and even if it has zero equity because I paid full price on it, I'm going to be able to sell that property in a way that lands me a non-refundable upfront deposit that we call an option fee. That's going to go right in my pocket. That's payday number one. Most of the time I'm going to have it set up where the financing that the seller gave me, or that exists with the bank where the seller borrowed the money from to buy the house that they let us take over, most of the time the payment going out is less than the payment coming in. So over here on that option fee, let's say you had to give the seller a little money. Let's say you paid a little closing costs. As long as the chunk of money coming in on the front end is bigger than the chunk of money going out, you made out. That's your first payday. Your second, third, fourth, fifth, sixth, seventh, eighth monthly paydays come in the form of a bigger chunk of money coming in monthly than is going out monthly. That's your positive cash flow. That happens monthly. Now, I like to call this one paper equity, because the value of a property is not a fixed number. It's a range, usually plus or minus like 5%. So that's like a 10% swing, meaning a $300,000 property could vary in value depending on the eye of the beholder between $285 and $315. That's a $30,000 swing, a 10% swing, right? So as long as I'm buying closer to $285 and then I'm not selling for $315, I'm probably selling for higher. I want to go a little higher than the appraisal range when I'm selling it. You could say, at least on paper, that I have equity. Now, I don't really have that equity because we don't know if our buyer is going to even cash us out at that inflated price that we're selling it at, or if it's even going to appraise for that at the time that they exercise their option. But if you buy it at $285 and you can make a good case that it's actually worth $315, you could say on paper your net worth is $30,000 more. That doesn't create a tax consequence or anything, but it does allow you to see wealth being built in real time, even though it may not get realized for a long time. In fact, you may not realize it. It could go away, or it could go way up. Okay, so I call that paper equity, because you don't have the money. Now, one thing that does happen is that you are paying down the debt month after month after month, unless you did like an interest-only loan. But that debt is being paid down, meaning the equity, the difference between the value of the house and what is owed on the house, also goes on that net worth statement, if you will, that you have equity in this real estate to a higher degree because you've paid down the debt. Without going through all the granular details of the tax benefits of owning real estate, you're allowed to depreciate real estate, and that also creates money for you. We don't know for sure if a property is going to go up in value, but there is that potential that it can go up in value and create yet more paper equity. What happens quite frequently during the term of ownership of this house is that the first buyer doesn't buy. Now you get to the second, the third, the fourth buyer, who are all doing all these things over here, right? All these ones over here. But you're also getting a big upfront payday from number 2, maybe number 3, maybe number 4. That happens over a period of a few years. And as if all of these paydays were not enough, but at the end of the day, or let's say the end of the term, called out by our buyer who's decided to exercise their option to buy, when we learn that they're going to exercise their option to buy, oftentimes that happens before our term runs out with our seller. And when that happens, we can go back to that seller and say, hey, haven't talked to you in a while, but I'm sure you're glad that I've been paying on time and doing everything I said, aren't you? Well, it looks to me like we got 12 more years to go. I got to thinking I might want to clean up my balance sheet a little bit and maybe just pay off some of these debts. But I'd just assume keep paying if you can't discount what I owe you. But if you can discount what I owe you, I'm not expecting you to do that, but if you will, then we can work a deal. If not, I'll just keep paying you monthly. You get your money, over the course of 12 years. But if you'd like to get a whole bunch of money now, let's talk about what we can do on that number that I owe you. And then here comes another discount, which creates more money for you. Sometimes quite a lot of money. So this is why I love these deals. They're actually easier than doing wholesale deals because you can give a seller full price. You don't have to worry about what their equity position is in the property. You can take over debt where there's no equity, or you can create new debt by getting a seller financing structure from the seller so that they can get more money over the long run on the house. I love these kinds of deals. They're so much easier to do than let me get your house for 50, 60 cents on the dollar. Okay? Now, if you think, oh, that's going to be so hard to get done, well, I'm not saying it's easy. We've got to be willing to do some things that others won't. But here's why some sellers will prefer this alternative. So let's go through these boxes. But the point is this is why sellers prefer this alternative sometimes. Not all the time, not even most of the time, but enough of the time to make a gigantic business out of this. Or if we lease it, there just aren't going to be any closing costs. They don't have to have their equity siphoned away. Like let's say it's a free and clear house. They don't have to have it siphoned away by realtor commissions and inspection concessions and fees and discounts so that the interest rate can be brought down. And a lot of times, like if their house is levered up with financing and there's not much equity because they put a 3, 5, 10, 15% down and the house didn't appreciate from the time they bought it a couple years ago, that 15% goes away real quick. But the point is that they don't necessarily always have to have the money that they have in it right away. Sometimes a seller would prefer to, instead of taking a hit for inspection, fees, commissions, that kind of thing, instead of taking a hit for all that, they'd rather have a note that involves all of their equity and they just get paid it over time because they're not going to do anything with the money anyway, but let it sit in an interest-bearing account that's only paying 4 or 5%, if that. Well, and this sort of makes that point. It's possible, even though most of the time we're doing direct principal reduction, it is possible that we would be paying them more interest than they would get in a bank. We might have to structure it over a longer period of time so that we help our cash flow, but they know that they can make more money sometimes financing it to us than getting cashed out. So for example, let's say they have a $500,000 free and clear house, and after all the expenses and fees and whatnot, they get like $460,000. So to put $460,000 in the bank and earn 4% interest from the bank, if they're even getting that, it takes a long time to grow $460,000 to $500,000 at 4%. But what if I give them $500,000 at 0% and we agree to like a 5-year balloon, pretty close to about the same, and they can keep all that money? Okay, the bottom line is this: the total amount that the seller is going to get because of the monthly payments as well is going to be way more money than if they just sold and cashed out on that $500,000 house for $460,000.